You didn't sell a single investment. So why is the IRS sending you a fat tax bill in March? This is one of the biggest tax traps for investors in taxable accounts, and it all comes down to how mutual funds work behind the scenes. In this video, I'm breaking down the tax trap most mutual fund investors don't see coming, explain how it works behind the scenes, and show you what to do instead. The mutual fund trap. When you invest in a mutual fund, you're not just buying a stock. You're buying into a pool of investments managed by someone else. And when that fund manager sells stocks at a profit, the gains don't just stay in the fund, they get passed through to you. That's right, you get taxed on shares of the gains whether you sold them or not. So let's take a look at what really happens inside of a mutual fund. Years ago, the mutual fund bought ExxonMobil at $25 a share. Fast forward to today, you invest in the fund, but now ExxonMobil, what's trading at $50 a share? Then bad news hits, ExxonMobil drops to $35 a share, and the fund manager, they decide to sell it. Now here's the kicker. You lost $15 a share from the time you invested. It was $50 when you got in, now it's $35, but the fund shows a $10 share gain. It was $35 when they sold it, their original cost was $25. That gain gets passed on to you, and it shows up on your tax return. So yes, you lost money, but you still owe capital gains taxes. Mutual funds, well, they track gains based on when the fund bought the investment, not when you did. So you could buy into it today and inherit a giant embedded gain. It's like picking up someone else's tax baggage. So let's break down some of the most common misunderstandings that blindside investors. Myth number one, I didn't sell anything. Why am I paying taxes? The reality is, because the mutual fund sold assets, not you, when fund managers sell stocks or bonds inside the fund at a profit, those capital gains, well, they're passed down to you, the shareholder, even if you didn't sell a single share. It's a behind-the-scenes transaction with a very real tax consequence. You bought in for the exposure, but you also inherited the fund's activity. Myth number two, capital gains are only taxed when I sell, right? Well, the reality is that's true when you own individual stocks, ETFs, or even real estate. But mutual funds are different. They're required by law to distribute most of their realized gains to the shareholders every single year. So even if you're just sitting on the fund and you haven't touched it, you're still taxed as if you did, and you get to participate in those internal trades. Myth number three, I reinvested the dividends, so no tax, right? The reality is this one gets a lot of people. Reinvesting feels like you never received the income, but from a tax point, you did. Whether the dividend or capital gains hits your bank account or it's automatically used to buy more shares, it's still taxable income to you. Reinvesting does help your portfolio grow, but it doesn't give you a free pass with the IRS. Myth number four, the fund went down this year. How am I paying taxes? The reality is this feels the most unfair. You see a red number in your account and yet you owe taxes. Here's why. The fund, well, it could have sold big winners earlier in the year. Stocks it held for years, locking in those capital gains. Then the market dropped in Q4. So you end up the year with a loss, but you still pay capital gains tax on the gains the fund realized before the decline. It's the old classic wound and salt scenario. Myth number five, why is my tax bill so high compared to my tax return? The reality is returns and taxes don't always line up, especially with mutual funds inside of a taxable account. If your fund distributed short-term capital gains, they're taxed as ordinary income tax rates, not the lower long-term capital gains tax rates. Add in redemptions from other investors, which force the fund to sell profitable positions, and you might get hit with a tax bill on money you never even saw. Myth number six, I just bought in December. Why am I paying taxes for the whole entire year? Welcome to the tax tail. If you buy a mutual fund just before it issues capital gains distribution, you inherit the full tax liability even if you weren't invested during the time those gains were made. So you could buy a fund in December 20th and receive capital gains distributions sometime in December, paying taxes for gains accumulated all year long. Myth number seven, aren't all dividends taxed the same? Nope. This one trips up even the most seasoned investors. Qualified dividends, those coming from most US companies, are taxed at a favorable long-term capital gains rate. That's 0, 15, or even 20%. But non-qualified dividends dividends, common in bonds, REITs, and international stocks, well, these are taxed at your ordinary income tax rate. Understanding the differences can significantly reduce your tax bill. Myth number 8, can I deduct my losses to cancel these out? The reality is you can do this only if they're realized losses, meaning you actually sold an investment at a loss. Unrealized losses, where your account value is down but just on paper and you haven't sold, they don't offset anything yet. So even if your portfolio is underwater, the capital gains distribution still hits and you still owe tax. So here's the big picture. You can get a tax bill for gains you never actually realized. That's why where you hold your investments matter just as much as what you invest in. Mutual funds are often better suited for tax advantage accounts like IRAs, 401ks, health savings accounts, or 529 plans, where capital gains distributions aren't immediately taxable. In a taxable brokerage account, you're often better off with ETFs or tax managed funds, which are designed to avoid these surprise tax events. So yes, you can really get taxed on investments you did not sell. The mutual fund trap, it's real, but now you know how to spot it and how to stop it from draining your portfolio. If this video made you realize you might be paying taxes on gains you never even saw, you're not alone. This is one of the most common and expensive investing mistakes I see so many people making. If you own mutual funds inside a taxable account, let me run an analysis for you. I'll show you how much you may have paid in capital gains taxes without even realizing it. I'll show you the internal expenses your mutual funds are quietly charging you, and I'll show you the tax drag that's eating away at your long-term returns. And if you're unsure of what you really own or how it's impacting your tax bill, my simple line-by-line report will break it all down in plain English so you can make smart, confident decisions with your hard-earned money. So book a free strategy call by using the link below, and I'll walk you through your current investments and see where we can start saving you money right now. I'm John Rojas with Tribox Private Wealth. Thanks for watching, and I'll see you in the next one.